The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to the basics of knockouts and binary options. My name is Todd Rich. I'm the head of education at Nadex. And can you believe it? We are getting our way through the month of July. This year is quite the blur, and I hope everyone is staying safe out there. And I also hope you're staying sane. I know this is certainly testing my sanity these crazy times. Anyhow, let's go ahead and get into today's session. This is going to be the basics of knockouts and binary options. If you don't know what they are, we are going to help you along that road. We're also going to be covering the Nadex platform, and we've got a new experience. It's constantly improving, and I want to show you some of the functionality there. And hopefully you'll be able to take away from this session some practical tools to help you on your trading journey. Before I get into the fun stuff, I am obligated to show you this disclaimer. Our webinars are all brought to you by our compliance department, and it is important that you do know that trading does involve risk and that all trading decisions are solely your responsibility and at your own risk. One of the big items here that I do like to point out is this is for your educational purposes only. Please do not construe anything I say today as a buy or sell recommendation. We are going to be playing with live data in the markets because that is the best and cleanest way for someone to really understand these products, our platform, and how Nadex markets work. So I necessarily need to show you some live data, but please, nothing I say should be taken as a buy or sell recommendation. With that, let me give you a quick little agenda of what I'm going to cover in the next 45-ish minutes. Sometimes I've been going a little bit longer because we've been playing a little bit with the platform, particularly with some of our newer functionality. I am going to define knockouts. What does that mean? I'm going to go through some examples and show you. My mom is from the great state of Missouri, even though I grew up in California, and in Missouri, it is the show me state. And I find that the best way to explain a lot of this is to show you. Then I'm going to do the same for binary options. And we're going to have a little bit of fun with binary options because if you're not terribly familiar with them or you really want to solidify how they work, I am going to go through a live example with our 5-minute binaries. I think it's kind of fun and exciting, but it definitely gives you a feel for how the prices of binary options move, what those prices mean, and how you could potentially take advantage of that in the markets. And everything is going to be on the platform. Now, I do want to say this up front. This is an interactive session. This is totally interactive. You have a little questions box. My colleague Sophie is in the background. She is awesome. Please ask her some questions. In fact, chat with her, keep her engaged. She's in the background there and she's listening along, and I don't want her to get lonely. So please, we're here to help you. The one way we can really make this work for you, and one way we can really help you, is if you reach out. So I want to encourage you to please interact with Sophie with the questions. And as I go, if you have questions around what I said, or the products, or the platform, or even if it's account related, funding, withdrawals, things of that nature, please. Sophie is back there. Please. She's a tremendous resource. She's available to you right now live through the questions function. So please take advantage of that. All right, I am now going to jump over to our website where we're going to spend the rest of the session. If you haven't noticed, we do have a very cool new website. We're excited about this. We're going to be making improvements to it, but I really like the look, the feel. It is very much refreshed, and it's always going to be a constant improvement, but it was time. We needed a new website. Very clean navigations up top if you're looking for information around our products or our markets. In our learning section, I would encourage you, this is where we put all upcoming webinars. In fact, let's go ahead and click over there. All upcoming webinars. And you know what I'm going to also do? I'm going to do this. As well as our on-demand archive. You can see this is the session we're running right now. We've got them out a couple of weeks. I'm going to be adding in August very soon. And I'm going to put a teaser out there. In fact, here in our archive, you'll find all of our recordings. And if you missed it, we did an education summit. It was a 2-day summit earlier back in May. Day one was basics. Day two was advanced. All of the recordings are here. If you'd like to go back and take a look at what we did, what we covered, there was even some trading strategies. Please take a look. You'll also find all of this on our YouTube channel. I would recommend you go to YouTube, you search for Nadex, and subscribe to our channel. There's plenty of recorded content there as well. And whenever we put something new, it goes up there as well. The teaser I'm going to put out is there's going to be an education summit at the end of the summer before Labor Day. Keep your eyes peeled. It's something we're going to do with our partners. I believe it's going to be hosted by DailyFX. If you haven't gone to dailyfx.com, incredible educational resource on all of the markets. Even though it says FX, they do macroeconomics for equities markets and things of that nature, which can help you with some of your trading decisions. We're going to be doing it with our parent company as well, IG, the FX brokerage side of the business. So take a look. Keep your eyes peeled for that Summer Education Summit. Trade your markets that we're going to be doing before Labor Day is the plan. All right, but yeah, take a look at around our website. There's plenty of some great, very useful information. The one thing I do like to point out is, trader, there is this chat functionality. Just as I mentioned, Sophie's here to help you in the background with questions right now. So I love that you're typing in questions to her. This is a way, if we're not on a webinar, you can always catch up with us. We try to make ourselves available. Plus, you'll find some information under our contact for you to be able to reach out to us as well. There's our email address. So Nadex is here to help you along on your journey. Now let's get into knockouts and binaries. I am going to log into the platform, and you now will notice that, and if you're brand new, this is what you'll see. And if you've been with Nadex for a little while, this looks a little different than what you were used to. This is our new shiny platform. We did not take away the old platform. If you notice in the upper right-hand corner, you still can go to the old platform if you like. That will eventually go away, but I would encourage you to start getting comfortable and familiar with using the new platform, which I believe is a much cleaner experience. It's a little bit more intuitive, it's less intimidating, and it's even got some better charting functionality for doing technical analysis, which is what a lot of people use to trade these markets. So again, you still can access the old platform. When you log in, you'll see it up here. The other thing I'm going to mention is I am currently in a demo environment, and this is very important. If you do not have a demo account, I would highly encourage you to get one. It is mostly live data. Sometimes the data in the demo environment gets a little out of sync with the live environment, but this is coming from the live markets. If I were in a live market, it would say live up here, But in a demo environment, you can practice. We give you practice funds, and you can learn to navigate the platform, where to click, how to set up your charts, and maybe even do some practice trades. Now, the trading experience won't be the same as live because you don't have the same set of eyeballs. People looking at a demo environment are just practicing, where the live environment, we've got a much more robust trading community with a lot of different people with a lot of different opinions. So your interaction with the markets is going to be different in a live environment than it would in a demo environment. Important to know that, even though we do try to um, we do pump live data into it. All right. Now, with all of that, let's get into knockouts. I am going to start with knockouts. Some weeks I start with binary options. I will mention call spreads. We'll get into that as well, but I like to do knockouts first. The reason I do knockouts first, and I'm going to click on knockouts, is because they are what is called a Delta 1 product. Well, that's a fairly fancy term. What does that mean? And when you're trading knockouts, a Delta 1 product means it moves in line with the price of the underlying. In fact, that is actually what you're trading, the price of the underlying. It is very intuitive. It's like trading a stock. When you trade a stock, you're trading the price of that stock right now. With knockouts, you're trading the price of the different indices, the foreign exchange, the currency, or the commodities. We've got crude oil and gold. In fact, let's have a little fun. Let's go with gold for our example. You're actually trading the current underlying price of the gold future. That's what you're trading. In fact, I'm going to go ahead and click this down. I mean, we can see that gold is currently trading, wow, up close to $1,900 an ounce. And the reason I brought up gold, it's kind of fun because I know it's become, I mean, this is, it's the price is risen. A lot of that is because the global economies, governments are printing more and more money to try to accommodate the economies as the economies struggle. So people are moving their money out of cash as that becomes a little bit more devalued as governments and central banks push more cash into the markets. And so, as a flight to security or haven, people are moving to things like gold and silver. So, for a binary, for a knockout, I'm going to click on any one of these four. Notice there's always going to be four knockouts. We have four knockouts for every one of our knockout markets. When I click on that, I am going to bring up a chart. I am now going to go down here and hide this so that you can see more of what I'm doing. I'm even going to hide my positions page. And we are going to get a nice view, and you can see how gold has been rallying. All right, here we go. There, I've got a nice, pretty picture. Up here, by the way, I can choose my date range. Maybe I want to choose a week. Look at what gold's done this week. It's gone up almost $100 an ounce. And maybe I want to see a little bit more frequency. I want to see a chart with every 10 minutes. So that's just how you kind of set those up. So you now know that I'm looking at a weekly chart of gold on 10-minute bars. And yes, we can see gold has indeed rallied. Now, for knockouts, what are we looking at when we're trading a knockout? And you'll see that the four knockout contracts are actually on each of the charts. Those are the blue lines over here on the left. And I could switch between contracts by clicking on any one of these. In fact, I'm going to go ahead and let's just say, now, not a buy or sell recommendation. My prediction, gold's going to continue going higher. All right. I'm picking that out of the air just for fun. Now, when I click on, you notice as I clicked on each one of these knockout contracts, that we got these big blue bars, one below and one above. That is the floor, the one below, 1881, and a ceiling, 1931. Okay. Now, what am I trading in a knockout? You'll see the indicative price on the order ticket. You'll even see it here on the chart is right around 1891.20. ticking up, and you'll notice the prices where there's the bid that I can sell or the offer where I can buy. And I was saying I was thinking it's going to go higher, so I might want to buy. So they're going to be right around that indicative price. That is what I mean by delta one. The price, the bid ask that you're generally going to see on a knockout are going to generally be around the indicative price of the underlying. And you'll see this is 20 or 30 cents wide. Sometimes it's 40. I mean, the market starts skipping around. Remember, I am also in a demo environment. Now, what am I, oops, you know what? I think I switched contracts. I want to click this one and I want to click buy. So I accidentally switched contracts. So we are on the 1881, 1931, and I want to buy it. And I clicked on the offer to buy, and it says 1891.30. Now I don't have to trade on these markets. I can put a bid below or an offer above. In fact, I'm going to just go ahead and put a bid at 1890, just for a nice clean number. Okay. And that's just so we can get a look at what we're doing. So what is a knockout? I've got a floor, I've got a ceiling, I've got an opinion. My opinion is I want to buy, I think it's going higher, okay? And if I were to buy one of these, and right now I've got 1890, let's put 1891 because that's actually a little bit close. That's actually could potentially be, in fact, I'm going to put that order in the market. Let's have fun. I want to actually place the order, 1891. All right, I'm actually right here on the bid. That's fine. And so if I buy one, I buy one. But this is, again, just my opinion. I wanted to put an order in the market. And in fact, down here, you can see that I do have an order in the market. Okay, maybe it'll trade, maybe it won't. Now, if I were to buy one here at 1891, okay, if I bought one, I know before I get into the trade what my maximum potential loss or maximum potential profit are. That's what the boundaries are. Those are the knockout levels. If I buy one at 1891 and I'm wrong, okay, I'm wrong and it trades down and it touches 1881, it goes down $10 an ounce. I would lose oh, and it looks like I actually bought one. Notice I got a position here. So I actually bought that one. Okay. Again, that's my opinion. I think it's going to go higher. All right. I'm now in this position. If it goes down and touches 1881, I would get knocked out for a loss. It is essentially a stop loss on this long position. I'm predicting it's going to go up. I bought one, and if it goes against me and I'm wrong, and it touches 1881, I will get knocked out of the trade and I would experience my maximum potential loss. Now, on the other hand, if it were to go higher, okay, my prediction is it's going to keep rallying because I think the price of gold is going to keep going up. If it were to go higher and it were to get up to 1931 and just touch it, it has to just touch 1931, I would then get knocked out for my maximum potential profit of $400. I know how much I could potentially make or potentially lose before I got into the trade. And now I'm in the trade. And if I'm right, I know how much the maximum I can make. Now, if it went to 1951, it went to $2,000 an ounce, I still cannot make any more than $400. Now, if I got knocked out for a profit, wonderful. I could then decide, do I want to put a different knockout on and buy another one? Or do I want to take a different opinion? Maybe I think it's going to go down. I don't know. The point being, your maximum potential profit and your maximum potential loss are a known quantity before you get into the trade, and so you know exactly what you're getting into. Now, if you wanted to have different risk parameters, you could build a trade around a different one of the knockouts. Okay. I mean, if I thought it was going to go down, maybe I would choose this one if I wanted to sell, because here I would, if I were to sell one up here, and it were to touch 1901, that's where I would, oops, I was wrong. It kept going higher, but it would give me more profit potential to the downside if I thought gold were going to reverse. So you're going to choose, you're going to choose your knockout based on uh, where you think it's going and what risk parameters that you've got in place. Now let's go back to my long side. I'm going to go back down to my positions. I'm going to go ahead and click on this position. And just by the way, if you're curious, who's making the prices here on the bid and the offer, uh, it is not Nadex. We are just an exchange in this product. Um, we've got market makers out there, but who else is making markets in these, putting prices up? It's our customers. Our customer, you can put a bid, you can put your bids in, you can put your offers in, and just like I did earlier here in this demo environment, I put a bid below, uh, and when it traded, at one point I was the bid for one. I was that market maker. If someone wanted to sell it, they had to sell it to me, which they did in this environment. So, it's a robust community of traders and everyone with their own opinion. Yes, there are some market makers to keep screens always lit, but for instance, in gold, the only time where we have enough, yeah, so no, I just wanted to put that out there. There are market makers and there are multiple market makers out there. And if you wanted to put your prices out there, you're allowed to do so as well. So that is a knockout. Uh, I've got my stop below when I bought it. I've got my profit goal above if I'm right, and I know how much I can make. Now the question immediately is going to be, what happens if it doesn't touch either one of these? Notice that this expires in 1 day and 1 hour. This is a Thursday, so this is these are all weekly contracts. What happens if it doesn't touch either one of those boundaries before expiration? And there, my profit or loss, and let's put that 1891 because I want to keep the price that I put in. Because I bought it at 1891, and yay, it's ticking higher for now. If it trades lower than 1891 and settles tomorrow in 1 hour, 1 day and 1 hour, and it's below 1891, but it never touched 1881, I would experience a partial loss. If it traded down $1, I'd lose $10. If it trades down in $10 and touches 18, I would maximum potential loss, $100 knocked out. So my loss would be if it trades lower would be somewhere between $0 and $100 if it settles lower. Now, if it settles higher, all right, I bought it at 1891, and let's say I'm right and it does trade up, but never gets all the way up to 1931. My profit would be the difference between where I bought 1891 and where it settles up above. So you will either get knocked out for your maximum potential loss or your maximum potential profit, but with a knockout, you could have a partial loss or a partial gain depending upon where it settles. Now, this is actually also very important. Just because there's an expiration associated with the contract does not mean you have to wait to expiration to see what happens. You can always trade out of a position early by taking a contra position to either lock in profits or minimize losses. Now, if it traded down and I was willing to risk $100, maybe my profit goal, yeah, it would be great if I made 400, but if I made 100, I'd be super happy. So let's go over here and I'm going to click on my contract down in my positions. It's going to populate an order ticket for me to take an opposite position. Now, I don't want to sell it here at 1892. Great, I can make $10, but I sold it at I bought it at 1891, so 1901. That's where I would want to sell it. I would take $100 profit. If it got up to 1901, I'd want to sell it. Now, this isn't really going to apply here. This is going to do the math assuming I'm selling and I have no other position. But here I'm just placing an order above the market for me to take a profit. And you can certainly do that. And I'm going to place my order, and you'll now see that I do have an order to sell it higher. Okay, it's currently 1892, right around there, and I'd sell it if it got up to 1901, and I would take my profit. So you can trade out early. Just because of an expiration does not mean you have to wait until expiration. In fact, here, you know what? I am actually going to, okay, strange. Okay. So that is what I wanted to show you with knockouts. If you've got any questions around knockouts, please, I hope you're engaging with Sophie in the background. Every knockout has got every contract has 4 knockout levels. And as you can see, if I went to this is a weekly contract, but if I wanted to look at just one day, and let's shorten this down to 5 minutes, and I'm going to shrink this chart a little bit so we can see, it does go through levels. It does touch them. And you can see where we've traded between. Here's a contract that, here it is in the last day. It had been dancing around this 1871 level, and if you were in this knockout one way or the other, you would have gotten knocked out several times. And then what happens is after something gets knocked out, we add a 4th one back in. So there'll always be 4. There'll always be 4, and we have that in all of our markets, whether it's gold or crude oil. If you were interested in trading oil, which was a great price action product, if you recall, when oil markets went crazy. But we've also got them in foreign exchange. All right, there's 4 different currency pairs, as well as if you want to trade equities, you want to trade the S&P 500. We've got knockouts around the S&P 500, the Russell 2000, the Nasdaq, and the Dow Jones. And again, there'll always be 4 of these. You'll find them on the chart. Okay, and again, you'll notice that the price that you're trading is going to be right around the indicative price. Delta One product, it's a directional trade, a knockout. I buy it if I think it's going up. I sell it if I think it's going down. I've got defined risk parameters around it where I would get knocked out for a loss if I'm wrong, which is essentially a stop. I get knocked out for my maximum profit if I'm right, which is your profit goal. And that is actually really important. Getting into a trade, you should have expectations of where you think it's going to go and where you would take a profit. In fact, a little analogy here, which I'm going to throw out before we jump over to binary options. There's a story. Why do people lose money in Las Vegas? And the reason people lose money in Las Vegas is because they go in with an attitude, I'm going to go in and I've got $300 in my pocket. When I lose $300, I'm going to quit playing. But they don't have a profit goal. Let's say someone goes in with $300 and they start playing in Las Vegas. Next thing you know, they're up $300 and they made $300. What do? They usually take their original $300, put it in their pocket and say, ooh, I'm playing with house money now. And they'll keep playing. Invariably, they'll lose the $300 they made. And what are they going to do after that? They're going to go back into their pocket and say, I was going to keep playing until I lost $300. So they keep playing until they hit their loss target. You should have a profit target whenever you're trading and know when you would take a profit and say, thank you very much, and then reassess your opinion or your positions then, but you should have a profit goal. With a knockout, you have your stop loss in place and you have a profit goal in place. And if you'd like to trade out of that early because you want to limit your losses and you were wrong, you can always get out of your trade. If you want to get out for a partial profit because your profit goal wasn't $400, it was only $100 or $200, you can certainly do that as well. I hope you're keeping Sophie busy back there. I certainly see hands raised and lots of questions. I would recommend typing in your questions, uh, and uh, and hopefully Sophie will get to all of them. I'll try to take a peek at the end if I can jump back and cover some of them. All right, next up, we've gone through knockouts. I'd like to jump over. Actually, before we go to binary options, I just want to mention call spreads because call spreads are also a very popular product. The difference between knockouts and call spreads, a knockout, if you touch one of your boundaries, you are knocked out. That is it. There is no slippage. The contract settles. You either recognize a loss or you recognize a profit. Call spreads, similar in nature, there's going to be a range. However, the difference is if it touches one of the boundaries, you are not knocked out. It can cross through a boundary and then actually go the other direction. So for your stop loss, it could go against you and you wouldn't get knocked out of the trade for a loss, but you still know that your losses are limited. So it gives you a little bit more time to be right. Uh, for lack of a better word, it's got optionality on it. Now, in fact, let's put up here's a call spread, and you can see now it's highlighted. This is what this particular call spread is. It's the 1850-1900 call spread, and it's the one at the top end of the range now because we list these each week. These don't stop trading. These are directional plays. You don't get knocked out. However, what you'll notice is the prices that you trade will not be directly around the indicative price. And that is because there is a premium in call spreads. There is optionality in it. It's going to trade a little bit more like traditional equity options. So there is a premium, there is time decay, there is volatility would get factored into the price of these. A little bit more complicated product. Similar in nature to a knockout, except if you touch a boundary, you aren't knocked out. You don't recognize your profit. You don't experience your loss. It gives you some time for the market to move around it. People will trade these and they might get in and out of them, but at least they know they're not going to, they won't be knocked out of the trade. But there is a premium associated with it, and we covered that call spreads in different sessions. I just want to mention they're available. Now let's jump over to binary options, because now binary options, unlike knockouts and call spreads where you're trading the actual price of the underlying, let's click on a weekly gold contract, and I'm now going to just pick one. You'll notice when I open up a binary, it's going to give me the current indicative price and the different settlement ranges. I'm on weekly, so it matches what we were looking at on knockouts. But then you have all these different strike prices. Okay, and you'll notice that the prices over here aren't the price of the underlying. So what are these prices? And I'm going to pick the one that's right in the middle, 1890.5, 1890.50. I am now going to move this away. And on our charts, you can actually see the different contracts. And I'm going to move this chart. And they're identified on the chart. You can see which contracts, what these represent. Now, when you're trading a binary option, this is a $100 contract, and it is purely a proposition. Will gold finish higher than this price, 1890.50, at 1:30 tomorrow afternoon? Now, what am I actually trading? The prices I'm looking at are the probability that this statement will be true. Now, with gold currently trading 1892 and it is above 1890.50, the probability that it will settle above 1890.50 in one day is currently, the market's pricing at around 55%. Or 56%. That's right in the middle of the bid-ask spread. If I thought gold were going to continue to go higher, let me just click 60. All right, and I wanted to buy one at 60. Again, we give you your maximum profit and maximum loss beforehand. Because these are $100 contracts, if I bought one at 60, that's the most I could lose. If gold settles below 1890.50, this contract will be worth zero. So the 60 that I paid for it would become zero, and that's the most I could lose. Okay. Now the most I can make, because it can only go to 100, which is 100% probability, if it settles above 1890.50, so 1890.51, it settles above 1890 and 51 cents. This contract would settle at $100. I risked 60, I get 100 back, I could potentially make 40. So I am risking 60 to make 40 if I were to buy one here. And what I would need gold to do is settle above 1890.50. Now, let's say I don't think it. I think gold's actually going to trade lower. I could potentially sell one of these. Now, let me just click the sell side, and I'm going to put in 55. That's the middle. Notice when I clicked buy, the blue area was shaded above. That's where gold would have to settle for that to be profitable. Now that I've clicked sell, in fact, let's just 55 is fine. That's right in the middle here. I would need gold to settle below 1890.50 for my short position to be to go to 100. So as gold starts ticking lower, then we can see it's trading 1890. It started ticking a little lower. The probability that it might settle below 1890.50 starts moving closer to 50-50. So if I were to sell one, if I sold it at 55, okay, so I'm going to actually take, I'm getting paid $55. I sold it. If gold settles below 1890.50 or 1890.50 or lower, because it has to be greater than 1890.50 or lower, this contract would be worth zero. All right, I sold it for 55. That's what I can make. Now, if it settles above 1890.50, so it stays above here and it settles above here, this contract would go to 100. All right, I sold it at 55. It goes to 100. I would lose $45. All right, so I know getting in what the maximum I can make and the maximum I can lose. And in the end, it is either going to be worth zero or 100. And if I buy it and it goes to 100, my profit would be the difference between where I bought it and 100. If I sell it and I'm wrong, that would be my maximum potential loss. Okay, so it does calculate. If that sounds confusing, your maximum potential profit, maximum potential loss are always calculated on your order ticket beforehand, and you have to simply make a prediction. Do I think it's going to finish higher than this price? Yes or no? All right, that it's a proposition. That's it. And the prices that you're trading are the current market's price of the probability of it being true. So you'll notice all the way down here at 1880.50, the market is currently pricing it at 86% probability of being true. Now, that's a pretty high probability. If you think it's definitely going to stay above here and you were to buy one for 86, so let's just click this and put in 86, I think it is definitely going to stay above 1880.50. I don't think there's any way it's going to settle below there in one day. That's your opinion. Because I'm buying it down here, I'm risking $86 because it could go to zero. If it actually sold off and settled below 1880.50, it would go to zero. I would lose my $86, but I could potentially make $14 if it stays up here. A high probability trade, but a lower potential profit. So I'm risking more, I'm potentially making less, but it's a higher probability of me being successful. Right? Now, these probabilities do move pretty dramatically. And just because there's an expiration associated with each one of these does not mean you need to wait until expiration to see what happens. You can absolutely trade these probabilities and they will change as time moves on and as the price moves on. So what I'd like to do now is really give you an example because these probabilities aren't moving dramatically. Let's go into, and I'm going to click over here on our markets. And you notice in binary options, we have our different market classes, and in each market class there's going to be different settlements, so different expiration cycles that you can choose from, right? So you see how long it's got to go till expiration, and they'll be different in each one. You know, they've all got different time frames. Now we do have very short term. We have 5-minute binaries. We even have 20-minute binaries. Our 20-minute binaries are all indices. So what's going to happen in the next 20 minutes in the equities markets? The 5-minute binaries are all currencies. And I want to go through an example here just because it's fun. Let's click on the Euro US dollar, and I'm going to pick any one of these to populate a chart. And I'm going to zoom in. Let's make this a 1-day chart with 1 minute. Okay, because these are short term, and I want to make sure we got them all in here. You can see how much this moves around. Okay, and in fact, let's hide this now. And this is a 1 minute, a 1-day 1 minute chart for the euro. Will the euro finish higher than 116.21? And this has only got 3 minutes till expiration. Okay, in 3 minutes, you're going to watch, it's like a little bit like a horse race, on how these probabilities will change as the price of the euro US dollar goes up and down, as well as how expiration moves. Because every one of these in 2 minutes and 44 seconds, 43 seconds, all right, and you can watch it here in the order ticket as well, every one of these will either move to 100 or to 0. So if I think it's going down, I could sell it. If I think it's going up, I could buy it. And you'll watch as it moves. Right now, we're right here near this 116.21 level. It's ticking lower. It immediately dropped below a 50-50 proposition, and it's moving. And notice this one up here, which was around 20, is now moving closer. Oh, it's coming back up. I mean, you can see how quickly this changes as the price of the underlying moves. So if you're looking for some price action and some very quick price action, 5-minute binaries, and for you to understand binary options, it's kind of fun to watch this because this is what will happen with all of our binary options in the last 5 minutes and in the last couple minutes, because it's either got to go to 100 or 0. So you can trade binaries around that price movement as time ticks on. Now, what will happen we've got 1 minute and 26 seconds here for this contract. In the last 20 seconds, you're going to see prices disappear. And that's because it's so volatile and everything is either 0 or 100 that no one really wants to take the risk of what's going to happen in those last few seconds. And as you notice, this one up here that was around 20 that went down to 10, as we move further lower and as we've only got less than a minute to go, this thing has already gone down to almost nothing. It's less than, the middle is 5. This one, the 1621, which was, we started, it was around 60% and it dropped to 50-50. It's now down where in the 20s, where this one was, because it's ticking lower and the time is disappearing for it to come back. Right? And this one here, which was up near 100, now the people are getting a little concerned. Now it's down around 75%. And here we go. I mentioned in the last 20-ish seconds, the prices disappear. Now we're going to watch. This one will either go to 0 or 100. We got to see what's going to happen as the price ticks here. We got 9 seconds to go. And I want to wait and see 5 seconds, 4 seconds. It looks like we're going to stay right between these, and there it was. This contract expired. This one at 1621, this one did go to 0. So if you bought it, it went to 0. If you sold it, you made your profit. This one down here, it went to 100. This one went to 100, so wherever you bought it, up to 100, you profited. And this one up here went to 0. If you sold it at 20, you made 20 bucks. And you could have made it in just a couple of minutes. This is binary options, and now you can see this contract is settled. And what happened here? The price is populated for the very next 5-minute binary. So now all I have to do is click on another one of these on my chart, and I can watch the next 5-minute race. Where is the euro US dollar going to be in the next 5 minutes? So I like to go through that kind of an example because our binary options now, you do not need to trade them in this volatile of environment, in a 5-minute environment, but a lot of people do like that excitement. They really want to know what's going to happen, and they see opportunities in the next couple of minutes for them to potentially make money or potentially lose money. They're looking for their opportunities, and it is very volatile and it moves around, but there are opportunities. But it's one of the better ways to really understand what happens in all binary options. But you choose a little bit longer dated one. So here's the S&P 500 for this week. And you'll see there are, we put these out at the beginning of the week, and you'll see the different probabilities, and it won't be as crazy volatile, but it can be a little bit as it gets closer to expiration in 1 day and 3 hours. Now, the last thing I'd like to do, I'm going to go back to our knockouts, is I want to show you a little bit of the fun things that we can do on a chart. I'm going to go back to commodities, and gold was kind of a fun one just because it's been pretty active lately. And as we're getting here, I want to show you some functionality on our charts. And again, I hope you've been typing in questions to Sophie in the background and keeping her busy. We do have some pretty cool functionality on our charts. These are better than the charts that we had on our old platform. Let's go ahead and choose a day. Let's actually, you know what? Yeah, let's go ahead and choose a day. Let's choose a week. Let's choose a week, and let's use 10 minutes. This is gold, a weekly chart of gold, 10-minute bars. And what I'd like to show you are some technical analysis tools. We've got some indicators, technical indicators that are built into our charts. Now you can set any of these up as you like. If you're not familiar with what any of them are, you can hover over the eye and it will give you some more information. If you're looking for a deeper dive, again, our partner, dailyfx.com, has a lot of education around technical indicators, so you can learn how to use them. But it's nice. If I like Bollinger Bands, which if you're not familiar, again, it's about standard deviation moves around moving averages. I can click on that, and that's the Bollinger Band width. I wanted the Bollinger Bands themselves. There we go. And you'll see them, they'll be populated on the chart for you. And let's just put a contract around that so you can see the parameters, and it can help you in making your potential buy or sell decisions. So take a look at these different technical indicators that you can put on your charts. The other thing that we have are drawing tools, where you can put on your own, say, support and resistance levels using a horizontal line. I might just look for spots on the chart where I tend to see prices moving, and I just clicked on one randomly. Again, not a buy or sell recommendation, where you might see potential buying or selling opportunities. Let's go ahead and delete that drawing and show you some other drawing tools, like a channel. Okay, we clearly are in an uptrend here, so let's put did I click channel? Let's try that again. Channel, there we go. And I can draw my up channel. I'm drawing skills here a little off. And let's zoom in on that. So there's my little attempt at an up channel. But you might see, hey, when it gets near the upper end of the channel, I might be thinking I want to sell. And when it gets to the lower end of the channel, I might want to buy. So you can put your tools and do up your charts however you like. We even have Fibonacci retracements. We're in a little bit of an up channel here. I can click on Fibonacci retracement. Since we're in an up channel, I would start in the bottom left-hand corner, go to the upper right-hand corner, and click again. And it's going to give me my different potential Fibonacci support and resistance levels. If you're not familiar with that, again, there's information on Fibonacci here under the information section. And Fibonacci is just a natural ratio that's seen in nature. Architecture, the human body, a lot of people are looking for those ratios to potentially replicate in the financial markets. So with that, we're at the end of today's session. I want to thank everyone for joining us today. I think we had a really engaged audience. I hope Sophie was able to answer all of your questions. Let me take a quick little peek. Maybe I can. This was recorded. It will be available on our website. It will also be up on our YouTube channel. Again, I would recommend that you take a look at our YouTube channel and subscribe to it. And be sure to take a look at our webinar section for upcoming webinars and other opportunities for you to learn with us. Thank you again for joining us today and being so engaged. I want to wish everyone good luck in the markets.